Good afternoon, class. Today we're going to discuss Chapter 5, the balance sheet and statement of cash flows. The learning objectives are to explain the uses and limitations of a balance sheet, identify the major classifications of the balance sheet, prepare a classified balance sheet using the report and account formats, identify the purpose and content of the statement of cash flows, and prepare a basic statement of cash flows. So the balance sheet, sometimes referred to as the statement of financial position, reports assets, liabilities, and equity at a specific date, provides information about resources, obligations to creditors, and equity and net resources, helps in predicting amounts, timing, and uncertainty of future cash flows. So the usefulness of the balance sheet. It computes rates of return, evaluates the capital structure, assess risks and future cash flows, analyzes the company's liquidity, solvency, and financial flexibility. The limitations of the balance sheet. Most assets and liabilities are reported at historical costs. The use of judgment and estimates, and many items of financial value are omitted. For example, historical costs of assets. Sometimes the value has changed due to the market, but it's not reflected. Also, use of judgment and estimates can vary depending on which ones you're using. And financial value, omitted financial value, for example, the text refers to like expertise of your staff. There's no way to actually capture that as a value. So identify the major classifications of the balance sheet. And so the elements of the balance sheet. Here you have assets, liabilities, and equity. And so assets are probable future economic benefits obtained or controlled by a particular entity as a result of past transactions or events. Liabilities are probable future sacrifices or economic benefits arising from present obligations of a particular entity to transfer assets or provide services to other entities in the future as a result of past transactions or events. And equity is residual interest in the assets of an entity that remains after deducting its liabilities. In a business enterprise, the equity is the ownership's interest. So the major subdivisions, you have assets, we just covered, and liabilities and owner's equity. And so types of assets for the subdivisions are current assets, long-term investments, property, plant, and equipment, intangible assets, and other assets. And for liabilities and owner's equity, you have current liabilities and long-term debt, and then you have the owner's equity or stockholders' equity. So the book noted in practice, you usually see little departure from these major subdivisions of a balance sheet. So now we break down the subdivisions further. So current assets, and so cash or other assets a company expects to convert into cash or sell or consume in either 1 year or in the operating cycle, whichever is longer. And so they're presented in a balance sheet in order of liquidity. And so, for example, here you have an item and then you have the basis for its valuation. You have cash and equivalents at fair value, short-term investments, generally fair value. Receivables are estimated amount collectible. Inventories are lower cost of net realized value or the market. And prepaid expenses are at cost. And so, again, these are items that either in 1 year or in the operating cycle, whichever is longer, that you're going to consume or convert to cash. So cash, generally any monies available on demand. And so cash equivalents, though, are short-term, highly liquid investments that mature within 3 months or less. Restrictions or comments must be disclosed. And so here you have an example of a balance sheet presentation of restricted cash. And so you have the current assets section, and then you have cash of $18,728,000. And then you have some restricted cash of $7.1 million. And you notice they have a note referenced here. So the note, which is accompanied information to the balance sheet, states that restricted cash and investments consist of certificates of deposit. And so that's why they're restricted. So here again with cash, you have another example. And this one's dealing with other assets. And so the current assets under cash and restricted securities, there's a fireboard portion with note 23 of $900. And other assets, you have restricted securities for note 23. And it's described here. So they broke it out between current assets and other assets. And the note is at the bottom to describe what it represents. And so this is a balance sheet presentation of current and non-current restricted cash. Next, short-term investments. And so they consist of items that are displayed in this chart. So your portfolio says you have held to maturity, trading, and available for sale. The type, debt or equity, Valuation is amortized cost, fair value, current, and they can be current or non-current. So short-term investments, here you have an example. We have cash and cash equivalents again of $170,000. Then you have some short-term investments of $1 million, and they have note 2 that accompanies them. And so the following schedule summarizes the estimated fair value of our short-term investments available for sale. And what makes up the $1 million is corporate notes, municipal bonds, and U.S. government securities. Receivables. And so major categories of receivables should be shown in the balance sheet or the related notes. And so a company should clearly identify anticipated loss due to uncollectibles, amount and nature of any non-trade receivable, and then receivables used as collateral. And so here we have an example of Stanley Black & Decker. Under current assets, you have cash and cash equivalents, and then you have accounts and notes receivable net. And that's net of this calculation here at the bottom with note B. So you have trade accounts receivable, trade notes receivable, other accounts receivable, gross accounts and notes receivable allowance for doubtful accounts. Well, gross accounts and notes receivable of $1.6 million, and then you have allowance for doubtful accounts of $63,000. And so accounts and notes receivable ends up being $1.5 million. That's the net. The net of allowance for doubtful accounts is what you reflect here in the example of this balance sheet. Inventories. And so disclose the basis of valuation, a lower cost of market, however you're valuing your inventory, and then cost flow assumption, FIFO or LIFO. And so here you have an example. This company has current assets and they're listing the inventories in that section. So you have logs and chips, lumber, pulp, container board, and other products, which total product inventory is $423 million. Then you have some material and supplies. In this example, you have the balance sheet presentation of inventory showing the stage of completion. So this is dealing with producing a product. So you have raw materials, work in process, finished goods, spare parts, inventories in transit, less provisions for inventory obsolescence, and net realized value. And so the note that accompanies this says inventories are measured at the lower of standard cost and net realized value. Prepaid expenses. And so payment of cash that is recorded as an asset because service or benefit will be received in the future. And so there's a cash payment before expense recorded. And so prepayments often occur in regard to insurance, supplies, advertising, rent, and taxes. And we've gone over prepaids before. Prepaid expenses, an example of how you would present that. Again, we've talked about cash, cash equivalents, accounts receivable, and inventories. And now we're in the prepaid subdivision. So prepaid expenses and other current assets are listed at $243,291 here. And then it'll give you your total current assets of $1.7 million. So summary. So cash and other assets a company expects to convert into cash to sell or consume either in 1 year or in the operating cycle, whichever is longer. And here on the balance sheet is showing you the section of your cash and cash equivalent items. So that includes accounts receivable, inventory, and prepaid expenses. Non-current assets. So long-term investments, securities, tangible fixed assets, special funds, and non-consolidated subsidiaries or affiliated companies. And so securities consist of bonds, common stock, or long-term notes. Tangible fixed assets not currently used in operations, like land held for speculation, make up the tangible fixed assets section. Special funds, sinking funds, pension funds, plan expansion funds, or cash surrender value of life insurance policies make up your special funds. And then again, non-consolidated subsidiaries or affiliated companies. So here you have a table for long-term investments. Again, portfolio type, valuation, and classification. held to maturity, trading, available for sale, the different valuations, amortized cost, fair value, and it can be current and non-current. So non-current assets, long-term investments, securities, which are bonds, stock, and long-term notes, are shown in this section of the balance sheet. So for marketable securities, management's intent it determines current or non-current classification. So this is the non-current section. And here you have your investments and your notes receivable, the non-current portion. Again, for your fixed assets listed here after notes receivable, land held for speculation in the non-current section. And your special funds, sinking funds, pension funds, cash surrender value of life insurance. And this will be listed in the long-term investment section of non-current assets. And lastly, long-term investments for our non-consolidated subsidiaries or affiliated companies. So our percentages in our other affiliated companies are listed here. So property, plant, and equipment on non-current assets. And so tangible long-lived assets used in the regular operations of business are physical property such as land, building, machinery, furniture, tools, and wasting resources such as minerals. With the exception of land, a company either depreciates or depletes these assets. So here you have property, plant, and equipment section. The company discloses the basis it uses to value property, plant, and equipment. And here they've listed the items that make up property, plant, and equipment, along with depreciation. So another example of property, plant, and equipment, we have listed land, building, machinery, capital leases, leasehold improvements, less your accumulated depreciation, tools, dies, and molds, and it gives you a total property, plant, and equipment net of depreciation. And so this is where intangible assets will be categorized on a balance sheet. So intangible assets lack physical substance and are not financial instruments. And so limited life intangible amortized, indefinite life intangible tested for impairment. And here you have intangible assets. So intangible assets consist of things such as goodwill, patents, trademarks, franchises, and copyrights. So as an illustration, Patrick Corporation adjusted trial balance contained the following accounts at December 31st, 2017. Prepaid rent at $12,000, goodwill at $50,000, franchise fees receivable of $2,000, franchisees of $47,000, patents $33,000, trademarks of $10,000. Prepare the intangible assets section of the balance sheet. And so here they've gone ahead and done it for you, and they're showing you that you will list goodwill, franchisees, patents, and trademarks. 50,000, 47,000, 33,000, and 10,000 for a total of 140,000. You would not worry about franchise fees receivable. So other assets. So items vary in practice, but they can include long-term prepaid expenses, non-current receivables, assets and special funds, deferred income tax, property held for sale, or restricted cash or securities. And so the other assets are listed in the balance sheet in this section after intangibles. The section should include only unusual items sufficiently different from assets in other categories. So here we have prepaid pension costs and deferred income tax as our example items. So classification in the balance sheet of liabilities. And so liabilities, companies classify liabilities as current or long-term. So here you have current liabilities and long-term liabilities. Current liabilities consist of notes payable, accounts payable, accrued compensation, earned revenue, income tax payable, and current maturities of long-term debt. Makes up your total current section, and then you have long-term debt, obligations of capital lease, deferred income tax, making up your total long-term liabilities in this example. And so obligations that a company reasonably expects to liquidate either through the use of current assets or the creation of other current liability are in the current liabilities section. That makes up notes payable, accounts payable, accrued, unearned, your income tax payables. And so another example, Halliburton Company. Under the current liability section, they have short-term notes payable, accounts payable, accrued employee compensation, some unearned revenue, income tax payable, accrued special charges, current maturities of your long-term debt. That's the portion of the long-term debt that's due currently. And you have your other current liabilities. So your long-term liabilities follow the current and the obligations that a company does not reasonably expect to liquidate within a normal operating cycle. And so all covenants and restrictions must be disclosed. And so again, here you have long-term debt, obligations of capital lease, and deferred income tax as your examples. So illustration. Included in Adams Company's December 31st, 2017 trial balance are the following accounts. Accounts payable, pension asset liability, discount on bonds payable, unearned revenue, bonds payable, salary and wages payable, interest payable, income tax payable. And so prepare the long-term liability section of the balance sheet. So here you would identify out of these liabilities, you identify the long-term liabilities, and that is your pension asset liability, your bonds payable, and of course your discount on bonds payable. So the other items, accounts payable, interest payable, salary wages payable, income tax payable are considered current liabilities. So balance sheet presentation of long-term liabilities along with the note disclosure. So here, of course, we had our total current liabilities. Then you have your long-term liabilities, and this says see note. So here the note explains this is a debt consists of, and they have some notes that are due, bank borrowing, commercial paper, all the items that make up this long-term debt of $254 million. So owner's equity. So owner's equity section consists of capital stock, additional paid-in capital, retained earnings, accumulated other comprehensive income, treasury stock, and non-controlling interest and minority interest. And so capital stock is the par or stated value of shares issued. Additional paid-in capital is the excess amount paid in over the par or stated value. Retained earnings are the corporation's undistributed earnings. Accumulated other comprehensive income is the aggregate amount of the other comprehensive income items. Treasury stock are generally amount ordinary shares repurchased that were previously issued, and non-controlling interest is a portion of the equity of subsidiary of a not wholly owned by the reporting company. So other companies that we owe interest in. So here an example of owner's equity for Las Vegas Sands Corporation. Under the equity section, they have their stock listed, preferred, common, capital in excess of par. They have their accumulated other comprehensive income, retained earnings, and that's their total Las Vegas Sands Corp stockholders' equity. And then they add in any non-controlling interest to give them their total equity amount of $7.9 million. So classification in the balance sheet. Here they're listing items and letting you know what the classifications typically are in the balance sheet, like where do they go. And so you have investment in preferred stock. Normally that's a current asset in the investment section. Treasury or common stock or stockholders' equity. Cash dividends are current liabilities. Accumulated depreciation is a contra asset in the asset category. Interest payable is a current liability. A deficit will be in stockholders' equity. Trading securities are current assets, and unearned revenue are current liabilities, because you have not earned the revenue yet. So next, we'll prepare a classified balance sheet using a report or account format. And so the account format lists assets by section on the left side and liabilities and stockholders' equity by section on the right side, which creates a lot of space. So most people like to use the report form. It lists the sections one above the other. And so this is an example of the report form. And so the underlying concept, the presentation of balance sheet information meets the objective of financial reporting to provide information about entity resources, claims to resources, and changes in them. And so here you have your current assets section that we discussed, long-term investments, property, plant, and equipment, intangible assets, which all make up your total assets. Then you have your liabilities and stockholders' equity, which consist of current liabilities, long-term liabilities such as long-term debt, and then your stockholders' equity, which consists of your paid-in capital, your stock, and your retained earnings. And then you have your total liability of stockholders' equity, which should balance your asset section. So identify the purpose and content of the statement of cash flows. So the purpose and content of the statement of cash flows. And so the income statement, the statement of stockholders' equity, and balance sheet each present some information about the cash flows of an enterprise during a period. The statement of cash flows presents a detailed summary of all cash inflows and outflows, or the sources and uses of cashes during the period. And so the purpose of the statement of cash flows is to provide relevant information about the cash receipts and the cash payments of an enterprise during a period. The statement provides answers to the following questions: where did the cash come from? What was the cash used for? And what was the change in the cash balance during the year? And so the content and format, you have three different activities. You'll have operating, investing, and financing activities. And so for the statement of cash flows, you'll have cash from operating activities, cash flows from investing activities, cash flows from financing activities. Then there's a net increase or decrease in cash, cash at the beginning of the year, and cash at the end of the year. This is the basic format for a cash flow statement. So operating, investing, and financing. Operating, cash effects of transactions that enter into the determination of the net income. Investing, making and collecting loans and acquiring and disposing of investments in property, plant, and equipment. And financing is obtaining resources from owners and providing them with a return on their investment, and borrowing money from creditors and repaying amounts borrowed. So this is a good illustration of cash flows and outflows. And so at the top of the line, you have your inflows of cash, and at the bottom, you have your outflows of cash under the different categories of operating activities, investing activities, and financing activities. And so operating activities, inflows, are cash receipts from revenues when they exceed cash expenditures. Inflows from investing activities are sale of property, plant, and equipment, sale of debt or equity securities, or collection of loans to other entities. And financing activities are issuance of equity securities or issuance of debt. Now, with your outflows of cash for operating, that's when cash expenditures exceed cash receipts. Your investing activities are purchases of property, plant, and equipment, purchase of debt and equity securities, and loans to other entities. And your financing activities are payments of dividends, redemption of debt, and reacquisition of capital stock, treasury stock. So how to prepare a basic statement of cash flows. So the overview of the preparation of the statement: information obtained from several sources. You get information from your comparative balance sheet, from the current income statement, and selected transactional data. And so as an illustration, on January 1st, 2017, in the first year of operations, Telemarket Incorporated used 50,000 shares of $1 par common stock for $50,000 cash. The company rented its office space, furniture, and telecommunication equipment, and performed marketing services throughout the first year. In June 2017, the company purchased land for $15,000. So in the illustration 519, it shows the company's comparative balance sheets at the beginning and end of 2017. And so here you have the company's balance sheet, and you have an income statement. And it's a comparative balance sheet because it's showing from one year to the next. And basically here they're showing you that after January 1st, there was an increase in each one of these categories. And then your income statement here, what's important is the net income. So there's an illustration for telemarketing company, their balance sheet and their income statement. And so preparing the statement of cash flow. So the 4 steps are: determine the net cash provided or used in operating activities, determine the net cash provided or used in investing and financing activities, determine the change in cash during the period, and then reconcile the change in cash with the beginning and the ending cash balance. And so here you're going to have an illustration of cash provided by operating activities. And so the net income was $39,000, and it comes directly from your income statement. Then adjustments to reconcile net income to net cash provided by operating activities: the increase in accounts receivable of $41,000, increase in accounts payable of $12,000, which gives you a net of $29,000. And so the net cash provided by operating activities is $10,000. So again, this information is pulled directly from the balance sheet and the income statement into the operating section of the statement of cash flows. So next, the company determines its investing and financing activities. And so cash flows from investing activities would consist of the $15,000 in purchase of land. And you recognize the net cash used by investing activities. Cash flows from financing activities are $50,000, the issuance of common stock, and payments of cash dividend of $14,000, which gives you a net of $36,000. And so net cash provided by financing activities is $36,000. And so that will give you have zero cash at the beginning of the year, so that will give you cash at the end of the year of $31,000. So we've gone through the operating activities, the investing activities, and the financing activities. So Kaiser Beverage Company reported the following items in the most recent year: net income, dividends, increase in accounts receivable, increase in accounts payable, purchase of equipment, depreciation expense, and issue of notes payable. So what are the activities? Net income is operating. Dividends paid would be financing. Increase in accounts receivable would be operating. Increase in payable would be operating. Purchase of equipment would be investing. Depreciation expense, operating. And issue of notes payable is financing. So it's important to know which activity these transactions fall under. And so here an example: compute the net cash provided by operating activities. And so here's a statement of cash flows in thousands. You have your non-cash credit to revenue of $10,000 and non-cash charge to expenses of $45,000. In your operating activity section. And so significant non-cash activities. And so significant financing and investing activities that do not affect cash are reported in either a separate schedule or at the bottom of the statement of cash flows or in the notes. And so examples include issuance of common stock to purchase assets, conversion of bonds into common stock, issuance of debt to purchase assets, or exchange on long-lived assets. And so here's an example at the bottom of this comprehensive statement of cash flows. You have purchase of equipment through issuance of $50,000 of bonds. Noted at the bottom here. And so again, you have your operating activities, investing activities, financing activities, and then your disclosure. And so that ends the lecture. We explained the uses and limitations of a balance sheet. We identified the major classifications of the balance sheet. We prepared a classified balance sheet using the report or account formats. We identified the purpose and content of the statement of cash flows and prepared a basic statement of cash flows. Please read the chapter and follow any exercises in Moodle. Thank you.